The investment philosophy that underpins the Share Plus fund is the same investment philosophy that we use across all Perpetual share funds. So we use a bottom-up investment process, trying to identify companies that represent quality and value on the long side. What do we deem as quality companies? Companies that have sound management, strong balance sheet, a quality business with a good market position, and the ability to generate recurring earnings over any market cycle.
And on the short side, we short each individual position we look to make money on in a market, whether the market's going up or it's going down. Now that might sound, well, of course you do that, but a lot of other funds who are like this try and short actually index rather than individual stocks, or they actually will try and short to hedge their existing position. We've got a very clear angle in every single short position we've got, and we'll make money if our angle plays through.
A 125-25 fund effectively means that you have up to 25% of the fund that can be short, and that money that's raised from the short ideas can be used to reinvest into your high conviction ideas on the long side. The flexibility that it allows a portfolio manager is that you can actually hold a lot more cash, but also you can actually have the same exposure to the market but a lower risk.
And just on that, what you'll find with the fund is we're typically a little bit lower beta than the market, and history suggests that that's the case. And there's two reasons for that. One is that we can hold more cash. We can hold up to 35% of the fund in cash, and we use that. When we don't finding the ideas on the long side, we'll have a much lower net, higher cash position. And the second reason why is our shorts tend to be higher beta than our longs, and therefore that lowers the beta adjusted net of the portfolio. We use the analytical team from Perpetual to help us there. And what we do is any company which has been kicked out of the Perpetual universe because it doesn't meet the quality filters, that comes into our universe. And anything which is ranked as sell by the analysts, it comes into our universe. And that gives us a good chunk of stocks which we can look at from the short side. The second thing I do is I look for red flags. Basically, the philosophy here is that we believe that management and management teams of companies, whether consciously or subconsciously, know problems before the rest of the market do. So we examine the behaviour of management teams when to provide another filter. And some of those red flags include a CEO or CFO suddenly leaving, and it's typically the CFO who knows the problem before the rest of the company does. It's a strange acquisition. We sometimes call it diversification, when the company goes outside its core, and usually that's to cover a hole in earnings, in future earnings. It's an over-promotional management, but also importantly is when the cash flow is not meeting the accounting earnings over a sustained period. Usually means the company's trying to hide what the true underlying strength of the business is. And so from once we filter that down to a few stocks or a dozen stocks, I'll do quite a bit of work identifying companies where we believe the market has materially overvalued them, and understand the angle that we've got, where we're different from the market, and prove whether I'm right or whether we're wrong.
There are a lot of skills that you need when you're shorting. I think experience really is very, very important. I think that's where we differ from a lot of the other competing products, is that Anthony and I have a long experience in shorting. But some of the things also is timing is very important. Sizing of positions is very important, because as a short goes against you, it gets a lot larger. Also being able to have conviction when it's going against you is also important. And they're probably the major factors that I think lead to success in shorting. The key success drivers of the fund over the last 4 years have been, well, first of all, it's a high conviction fund. We've been very contrarian in some of those conviction ideas. So stocks that have been out of favour, in particular, two examples, Harvey Norman CSR, have been great performers for the fund. We've identified small companies early that have performed extremely well, like Magellan. That has been another great contributor. But it's also been what we've not invested in as well, using the Perpetual process. Stocks like Newcrest and QBE, who have been very poor performers over the last 3 years, we haven't been invested in.
We work quite well as a team. Paul and I have quite complementary and different skill sets, where I sort of focus most of my time speaking to companies doing the research, the analytical work. Paul is much better at the risk management of the portfolio and understanding where the market's heads at on each individual stock. And those two skills complement each other very well. I won't mention any specific stocks, but a sector where we've made very good money has been mining services. We identified about 18 months ago that this sector, which was very much loved by the market, it had a golden 5 years of where revenues have grown, margins have grown, and the PEs are expanded. And so the share price of these stocks up to about 18 months ago had been very strong. What we identified at the time is two things. First of all, we identified that the capex boom in mining was peaking in the next, was peaking and starting to come down. There weren't going to be much more in the way of iron ore or LNG plants built over the next few years, and so we saw that the peak was happening. The other thing we identified, speaking to BHP and Rio, is that their focus had changed from grow at any cost to we want to screw down our operating and capital expenditure budgets over, and concentrate on cash flow, and so. What this reminded us of is Coles and Woolies, which 5 years previous, when they stopped growing, started really screwing down their suppliers, and it really hurt the guys who were supplying Coles and Woolies. We thought this could start happening to the mining service companies. Sure enough, this is exactly what's been happening. You've seen revenues stabilise to start going down in the mining service companies. You've seen the margins really come off, and I think we're just seeing the start of the Rio and BHP really squeezing the margins on these on their suppliers. And so we still have a short position in some of those, in some selected mining service companies, but we've made good money on a lot of them.